We're counting down to the opening bell. Joining us now is Ashish Shah, CIO of Public Investing at Goldman Sachs Asset Management. Ashish, it is only Wednesday, but it feels like it's been a month and a week here, given all the wild swings. Even this morning, we're seeing the ADP report revive concerns about a growth slowdown, and then we're seeing bond yields sort of move around. What should investors be doing right now?
Yeah, so look, this kind of environment creates a tremendous amount of opportunity. So I think the first thing is that investors have to look back at their portfolios and remind themselves that they're in it for the long term. The opportunities that we're seeing, which we've been talking about since really the end of last year, are broadening equity markets. You know, year to date, the U.S. may be down, but Europe is up, and it's up double digits, right? Hong Kong is up like 15%. So you're seeing tremendous opportunities there. And there's also opportunities to generate income in your portfolio.
How do you do that, generating income?
So,
and talk about bonds, equities, and their role, what the mix should be like right now.
Sure thing. So I think one of the most important things when it comes to generating income is you can't simply rely on your bond part of your portfolio to generate income. There are a lot of other opportunities. So take, for example, the volatility we're seeing in the equity market. VIX is in the 20s today. You're going to see volatility. This is a great opportunity to sell options against your S&P positions or to go into an income generating, dividend heavy type of equity portfolio. On the other side, when it comes to bond markets, look at today, you're seeing German bonds sell off. At the same time, the U.S. is holding in really well, and that's because relative growth is very different across the world. That's creating great relative value opportunities for active bond managers like ourselves, and you can take advantage of those by going into kind of an unconstrained dynamic bond fund.
We're hearing the word stagflation reappear again. We heard a bit of that when rates started going up. It's one of those 1970s ghosts that comes back once in a while. If that does happen, to whatever degree, how should your portfolio look?
Yeah, so I think that what worked back then is making sure you were generating lots of income because it allowed you to reinvest back into your portfolio, making sure that your income was generating a lot of after-tax income because at that time taxes were really high. Yeah. This time may not be quite the same, and so I think either way you want to be really diversified in your portfolio. But remember that income piece of your portfolio, which a lot of people, as equity markets have been going kind of up and to the right, they've forgotten about, and they've been afraid of bonds. I think this is a good reminder year to date that bonds are actually your friend in volatile markets.
Ashish, you mentioned the outperformance of Europe and Hong Kong relative to the U.S. so far year to date, and it's been pretty stark in terms of what's happening in the economies. Right? We just were talking about earlier. Germany kind of taking off the fiscal restraints, going to borrow and spend a lot more. At the same time, the U.S. is actually kind of tightening things up on fiscal, at least trying to, and U.S. consumers seem to have had a bit of a hangover coming into this year. Is this sustainable, and can it actually operate smoothly, or is it creating some kind of tensions with these growth divergences?
Look, we've seen this dynamic since the pandemic where the U.S. has been kind of a year ahead when it comes to the growth cycle relative to Europe. Right? So last year, Europe had a rough year growth-wise, and the U.S. was gangbusters. We started to slow, then we had re-acceleration. We're calling for or concerned about a reigniting of inflation. Now you're seeing the reverse. You're seeing the U.S. cutting. That means you're going to see deceleration in the U.S., maybe some Fed cutting later on this year. Which is actually going to be a good thing because, as we've seen, with lower interest rates come housing demand.
Could the Fed cuts come sooner rather than later? If the jobs picture weakens, we don't see immediate increase in inflation, even if you're worried about additional effects to come down the road.
Look, I think it's important to remember that the Fed already cut 100 basis points. Yeah. And so, but we were at the start of this year, we were starting to price out any Fed cuts and talking about Fed hikes. So that's why I think it's really important when you get these big kind of overshoots in markets that you have to be willing to step in and play the long game. And, we think that interest rates are going to head lower over time, as the U.S. economy decelerates and as inflation gets back into the right zone.
And lastly, the retail investor holding in there right now?
I think the retail investor is taking a pause. We've seen through our, AI and, quantitative analytics that, that the retail investor is really kind of pulling back. And that isn't surprising to us, given how kind of forward-leaning that investor had been. It's time for like the meme stocks and other things to take a break. This is an environment for long-term investors, and that's why I'm really excited about it.